In the case of Berkshire Grey, we've written 2 research pieces, and then I'll come over the top and do a video on those that we think a YouTube audience might find interesting. And quite a few of you have requested that we cover Berkshire Grey. So we're going to do that. And I think there's a couple reasons why this company is in demand so much. And the first is that the warehouse automation theme has a lot of potential, anywhere from 150 to $250 billion total addressable market. And you can tell that when you look at all the players. And this is a market map. This isn't even the complete market map, but if you look there, sort of around the center left, you see that acronym ASRS, storage. That stands for Automated Storage and Retrieval System. And there appears to be about 76 different companies working on that sort of technology. One of those there, you could see Ocado's logo. They're a UK grocer that has been in a legal battle with AutoStore, which is perhaps, if you had to pick a leader, they're going to be the leader by any number of factors. So warehouse automation has a great deal of potential, and that's attracted investors. Berkshire went public using a SPAC, and we by now all know that SPACs did retail investors no favors. We've been saying that ever since the SPAC debuted, and out of the close to 100 disruptive tech SPACs that we've covered, we invested in only one, and then in a very small position. So Berkshire Grey has that going against them. But let's first talk about the ASRS market, which is the warehouse automation theme that we want exposure to. And whenever we look at a growth thesis, we try to find leaders. And this is an interesting chart taken from the AutoStore investment deck, and it shows how the ASRS market is served by 4 solutions. You have cubic storage, shuttle, AMR, AGV, and mini load. And cubic is the fastest growing, and you can see that they've placed themselves in that section alongside of Ocado. And whenever you have a large total addressable market, there are legal battles as companies try to create moats or competitive advantages using their intellectual property. Now, you won't notice Berkshire Grey on this slide. Why is that? Well, maybe it's because Berkshire's products don't fit into a comprehensive warehouse system. So you see here the different types of products they offer. So there's pick and sort, pick and pack. There's some robotic automation bits there, an induction system. And these are the things that Berkshire sells. And when we start looking at the revenue for this company, the Q1 2022 results here, as you can see, they've dropped dramatically from last quarter, and the company doesn't address that. They simply address that number relative to where it was a year ago. So that's $5.5 million compared to $4 million a year ago, and the change is primarily due to an increase in customer deployment activity. Well, of course, but we're interested to know why it's dropped so sharply from last quarter. And we get this little explanation in their 10Q, which says our revenue can fluctuate significantly from quarter to quarter depending on the number of projects in process. So it's important to understand their business model. When we look at that, we see that revenues are primarily generated from the sale of hardware solutions, and that the company over time expects to realize recurring revenues from software maintenance and other services post-installation. And that would also include these purchase options they have for a robotics as a service program. And then they go on to talk about how the company's contracts have multiple performance obligations, including things like system delivery, installation, testing, and training. And they'll recognize revenues along those milestones, and that's why they're lumpy. And they also talked about how large orders from a small number of clients create some of that lumpiness. Now, when we look at the bigger picture here, you can see that this is taken from their SPAC deck. We've always been critical of companies that don't follow through in their promises. They missed their 2021 revenue number by about 9 million. That's not horribly bad. But then when we look at their reiterated expectations for 2022 of approximately 90 million, That's versus a SPAC deck estimate of 119. We don't like to see companies that don't follow through on their promises. And Berkshire didn't raise a ton of money. I believe it was around $250 million in their SPAC. But they had also mentioned this new customer element for this year. And it says 119 potential customers identified, pipeline of 163 projects with total value of $400 million. Then you look in their 10K and it says, we will continue to derive a majority of our revenue from a limited number of significant customers in future years. Well, which one is it? So it's these sort of discrepancies that we don't like to see. Now, when it comes to customers, Berkshire has some marquee names. There's Target accounting for 32% of their 2021 revenues, then TJX and FedEx. It's great to see. And then the year prior to that, Target was 70% of the revenues and SoftBank was 30%. So for the last quarter, the company generated, you can see here, 38, 14, 12, 12, 12% of revenues from 5 customers. So 88% of the revenues came from these 5 customers. We don't like customer concentration risk. So when you have a big firm like Target as your primary customer, that's a double-edged sword. So it's great that you have that big name because you can use them as a reference customer when you're out getting new customers, which is why it's important that they're getting new customers, but they don't appear to be planning for that to happen. But it depends on which deck you look at. But the thing is that it's also the case where a company like Target can suddenly change directions on a whim, and you're left sitting there, as they say, with your dick in your hand. So this is something that Berkshire investors need to consider. And this is the most concerning element out of everything. And it's that they're not building a profitable product. So if you look at gross margins, again, we fully expect a firm like Berkshire to be losing money. That's not a problem. Most firms that we look at, high growth firms, are losing a lot of money as they move to capture market share. There's nothing wrong with that. But most those firms have positive gross margins. Look at this. For 2020, they had a gross margin of 8%. Okay, that's really tight. You don't have a lot of margin for error there. In 2021, they had a negative gross margin of 16%. That means that they're not able to sell their product profitably. So the cost to produce the product they're selling is higher than what they're able to realize from it. That's not good. You at least have to have a profitable product. And then this latest quarter, 22% negative gross margin. You can see it right up there. And they said this resulted in increased overhead resulting from the growth in deployment operations. We've seen this different verbiage around this idea of future deployments are costing more now, which is why we're not profitable. And that's not good. So at what point do we need, can we expect to see profitability? Well, they say, we expect we will need to reduce product costs in order to improve gross margins for the foreseeable future. Well, lowering the cost of your product over time, that's how you're going, or keeping the same cost of product but lowering your costs is difficult when you're using contract manufacturers. And they talk here about, by scaling our revenues, we expect to be able to lower our solution costs through increased volumes with contract manufacturers. What sort of discounts are they expecting to receive, and when will those kick in? And then they talk about how scaling revenues will allow them to leverage other overhead costs, really cost dilution that will contribute to gross margin. Well, first of all, the trend's going in the wrong direction. And second, how long do we have to wait for this? Because this firm, like other firms, needs money to survive. And that's becoming a bigger and bigger problem these days as the bear market we're in keeps investors from getting into deals without, let's say, giving them very favorable terms. So Berkshire Grey had loss from operations last quarter of about $30 million. They have about $140 million in cash left. They anticipate, as they said in their deck, we anticipate the money on hand will last us for over a year. And indeed, we can see the runway is a year and a month based on that 30 million burn. So if they're going to raise more money, and since they're selling a product that doesn't generate any profits, they're probably going to have to, is that going to be equity or debt? Well, there's a problem here because when you look at their existing shareholders that might be looking for an exit event, you have names like Coleslaw, New Enterprise Associates, which is one of the largest VC firms in America, and then SoftBank. And all three of these stakeholders are probably going to be looking to exit their positions. Typically, a VC doesn't stay on after an exit event. And I was just reading recently that Sequoia is being criticized for doing that, for staying on once they have an exit event and trying to gain more value after that. Well, these firms are going to be looking to potentially exit their positions. SoftBank has specifically talked about that, not in reference to Berkshire in particular, but in reference to their venture portfolio. So this doesn't bode well. There's a lot of shares that are going to be dumped on the market, which will put some pressure on the share price, which means that they're able to raise equity at much less favorable terms for existing shareholders. And then there's debt. Well, that, again, when you look at the promises that they made and weren't able to keep, that's something that future investors are going to look at. And they haven't blown their numbers by that much, you could argue, but still, this is a firm that's not a leader in what they're doing, and that's a concern, and especially a concern when you compare them to a company like AutoStore, which is 15 times the size of Berkshire. We always invest in leaders, and we would never consider investing in Berkshire at their current market cap, $351 million, because we have a cutoff at $1 billion. We don't invest in companies with a market cap of less than $1 billion. So for Berkshire, we wanted to calculate the simple valuation ratio. We used their 2021 revenues because the lumpiness in quarterly doesn't make sense to use that quarterly number. So they have a simple valuation ratio of 7, and we calculate AutoStore's same ratio using their Q1 2022 revenues, comes in at around 11. Well, we're more than happy to pay that premium for a company that is arguably a leader in warehouse automation, at least in the cube storing solutions. And what will happen is when you have a leader like AutoStore, they can then, and AutoStore doesn't have that much cash. I think they have around 80 million, but they've moved into profitability. They can drop the pissing contest with Ocado, then maybe they can start picking up some other firms out there that have best of breed technologies and consolidating the warehouse automation space. So if we were going to consider any company in warehouse automation, it would be the leader. And right now that would be AutoStore, and others have mentioned Symbotic. Well, the research analyst is working on that right now as I speak. So looking for leaders in a niche, AutoStore 15 times the size of Berkshire Grey. Berkshire is just too small for us to consider. Automation players in scope that we're looking at right now: Berkshire, Ocado, AutoStore, Symbotic. Others, we're not aware of any. If you know of some, nothing over the counter, please. Nothing private. Just publicly traded stocks. Do drop a note. Berkshire's far too small to be on, to be considered for our portfolio. And they're not selling a profitable product. And that seems to be a requirement these days when we're looking at firms. We now look at survivability in things like runway and gross margin. So this is a firm that we would never consider investing in, and we would avoid. So please put your comments in the comment section. Make sure to subscribe to our channel. And thanks so much for taking the time to watch this video today.